Good afternoon, everybody. Welcome to our webinar entitled The Spectre of Tax Changes. Is this a good time to sell your business? I'm Matthew Katz. I head up the corporate finance team here at Buzzacott. I'll be joined, and hopefully we can see me. Hi, everybody. And I'm in the office. I think I'm not going to be in the office for much longer, judging by the changes today. And just rewinding, the very first webinar I did was on the 23rd of March, when Boris then stood up that evening and then sent us all home. So this is my first and last webinar from the office. If anyone comes in, I apologise. It's easier to control things at home than it is here. Anyway, I'm joined by Alastair McQuater, our esteemed, one of my esteemed tax partners. Afternoon, Alastair.
Everyone.
And we're going to have a half an hour, 45-minute chat whilst hopefully you can all have your lunch or sit back and have a coffee or do some other work while you're listening to us in the background, whatever takes your fancy when you're listening to these webinars. And what we're trying to do is to talk you through some of the backdrops and changes to CGT and what might happen. And I'm going to sort of ruin the answer that Alastair and I don't know what happens in the end, obviously. But we're going to talk you through those, our thoughts. We'll have a bit of debate, ourselves about what could happen, and talk about some of the things that you may or may not be able to do, in advance of any prospective tax changes, and also talk a bit about, just the M&A world overall, to put it into the context of whether actually, there is a window now when you can be selling your business. So I think we've got a mini agenda. And we've got Amy producing in the background. Thank you very much, Amy. So if I refer to Amy, that should be flicking through on the slides. So there we go. So there's the backdrop on COVID tax in the M&A market. Alastair is going to dive in with a brief history of CGT. He's promised us all he's going to keep it brief. And I think we've spared you. Alastair and I spent an hour and a half listening to the CIOT and Institute of Fiscal Studies sort of talk on capital gains tax changes. So we're going to condense that right down to about a minute. We're going to talk about what might give and when in terms of capital gains tax, and touch on what could you do to take out any risk or any changes. So very quickly, the backdrop. Sadly, it looks like COVID is rearing its head again, and sadly that means that there's going to be more government expenditure going out the door. There's already, and if any of you have watched any of the webinars I've done over the last six months or so, that there's already been an inordinate amount of money spent to sustain employment in the country. There's going to be inevitably more spent going forward. That means that at some stage it's all going to have to be paid for. So that's the backdrop on the tax side, and Alastair will fill us in more about what has been talked about, and it's the CGT thing. I think isn't just something that's popped up in the last 6 months or a year. It's been something that's been ongoing. As for the M&A market, right now, it's a really good place right now. We're seeing probably more transactions than we've ever done. There's a shortage of good businesses, and there's a lot of money and liquidity in the market, and so we are seeing buyers coming back around, revisiting transactions that they might have let go of back in March, and in some cases paying more money than they were back in March. So there's a lot of money out there. Again, as we move into a world of possibly negative interest rates, that's going to change the market dynamic even further. And those sitting on pots of money are going to have to deploy it. So if you've got a good business in a good sector, and sadly, there are some sectors that aren't in great shape, but if you've got a good business in a good sector, this could be a really good 3, 6, 12 months to sell your business, despite what's going on around us. So that's enough backdrop for me. So Alastair, are you ready to share the history lesson with us? And time to make your coffees if anyone wants to. Sorry, Alastair, over to you.
Matt, thank you. It's always nice to be set up so beautifully to
I apologise.
Keep everybody's attention going. Hopefully there's a slide with a summary going to appear. But I think the first thing to say is that CGT is a pretty young tax. It's a year older than I am, so it's definitely young. Introduced by James Callaghan in the mid-60s. Prior to that, short-term gains had been taxed as income, but essentially capital gains in the United Kingdom were tax-free until 1965. And for those of you who get involved in big discussions about your tax returns, a lot of the case law that we refer to was from the days when you really wanted everything to be capital, because capital was 0% tax, whereas income was very high. There's always been something called retirement relief, which was aimed at entrepreneurs and that kind of business sellers. Obviously, retirement relief wouldn't be legal now because it was age related, but there's always been something there, and that needs to be kept in mind. The first big change was to allow for inflation with indexation allowance. And then we went through rebasing original costs in 1988. We then said, well, you allow for inflation, but inflation can't create a loss. So we took the tax away from economic reality, that you can actually lose money over time, which wasn't terribly helpful. But we then moved completely away from the standard capital gains tax and went to a taper relief, so gains tapered over time. And retirement relief went, and business asset taper relief came in for sales of shares and business assets. And that was the first time that we had this 10% rate of tax, which then became entrepreneurs relief. Rates aligned with savings income rather than ordinary income. Taper relief period went down from 10 years to 4 years, which was the first really big change for entrepreneurs. And then entrepreneurs relief came along itself in 2008 with a £1 million lifetime limit, a number which is where we are again now, having spent nearly 10 years with a £10 million allowance. Entrepreneurs relief no longer exists in name, albeit it's the same relief. It's now called business asset disposal relief.
Was that someone at the Revenue having a bit of a pun, Alastair, on bad relief?
It seems that it might have been, yes, and certainly the economists are loving it. But there we go. And then we've had various extensions to non-residents, and one, I think the residential property probably isn't terribly relevant, but temporary non-residents used to be one of the capital gains tax planning techniques. Back when you had 40% tax, you used to go to live in Belgium or Portugal, which had beneficial tax treatment. Nowadays, you used to be able to do it for 12 months or 14 months. You now have to do it for 5 years, which is significantly less attractive. But then one big change, and I know Matt will talk about this a little bit later, is the creation of the employee ownership trust and the tax-free disposal into employee ownership trusts in 2014. And whilst entrepreneurs relief has been targeted in the press over the last few years, EOT disposals haven't been targeted, so they seem to still be attractive. So if we then move on, just a quick summary of what rates have looked like over well, not quite the life of capital gains tax. But if you see at the start, we had income tax rates that could hit 80% or so, but CGT at 30% and a zero retirement relief on relatively small gains. The Thatcher government saw income tax rates come down, but no change to start with in capital gains tax rates. Income tax rates then came right down to 40%, and capital gains tax rates then were set at the same level. So you paid the same rate of tax on income and gains, other than for retirement relief, until the late 90s, when taper relief came in and everything changed, particularly for entrepreneurs. The rates have then gone up and down, but have stayed well short of income tax rates. So if we then move on,
Cool. Alastair, can I just interject there? So my sort of corporate finance career, which probably started in, I don't know, late 90s or so. I think basically for the whole of my corporate finance career, the underlying tax rate for entrepreneurs has been pretty damn low. Throughout, and we talk about, and we're supposed to use the word spectre because it it could be a fairly gloomy thing coming up, but before that, there were high rates of CGT that entrepreneurs were paying.
Yeah, for the first first 5 or 10 years of my career, you were paying 40% tax, unless you were over an arbitrary age limit when you disposed. So yeah, it's a generational thing. People my age and older are used to relatively high rates of capital gains tax. People your age and younger don't believe they ever existed.
I'm glad we got that clear separation of ages in there, Alastair.
Absolutely.
Anyway, moving on. Sorry to interrupt.
No, it's fine. But then we have a lot of talk about capital gains tax in the press, and why we should have changes. But this diagram just shows how unimportant capital gains tax really is. There are 3 taxes that matter to the UK economy, really. They're income tax, national insurance contributions, and VAT. The rest are pretty trivial individually. And capital taxes, of course, isn't just capital gains tax, and we'll touch on this in a minute. It also includes inheritance tax, but together they raise about 5% of tax revenue for the UK. This is not a particularly big deal economically. So if we then move on, in the summer, the Chancellor announced that he wanted a review of capital gains tax. He's not the first person to talk about it. George Osborne, 4 or 5 years ago, talked about changing capital gains tax, bringing it more in line with income taxes, which is when the gains tax rate went up to 28% briefly. Worryingly, the review is aimed at individuals and small businesses. The rules are similar for corporates, although they pay corporation tax on capital gains. It seems to be wide-ranging, so it's not just rates, but it's also allowances, exemptions, and so on, which is really the tax base as opposed to the rate of tax. But he's also asking for a review of the interaction of capital gains tax and the taxation of other types of income. And this is something which is strange to a tax person. Gains are, in UK tax law, not income expressly. Go back to the pre-1965 rules, gains were exempt from tax. Income is something different. But politically, the language is changing so that gains are now income, and this is all on the back of the likes of carried interest and the Warren Buffett comments about paying less tax than their cleaners. So the politicians are following the press, I think, to a degree. Over the years, we've had this history of tinkering with capital gains tax. And so tinkering seems likely now, which is irritating, because capital gains tax is actually a relatively simple tax in itself. But there are various parts of capital gains tax which have always been there. Reliefs such as the principal private residence relief, a form of retirement relief, rollover for business assets, gifts of business assets, and certain small value assets. And the question, I think, is how brave will government be if it's going to review capital gains tax? Capital gains tax reform, i.e. tax increases, is politically popular, particularly apparently with Tory voters. So with the current government, you can see an attraction. But why is that? Well, only 300,000 people pay CGT at the moment, and only, less than 20,000 taxpayers make gains of more than 500,000. So this is a really small proportion of the voter population that are involved with capital gains tax. So it's an easy win in government's view. But go right back to the start. CGT was introduced because of property price increases post-war. Hey, but we still have a PPR exemption. I suspect CGT reform would be significantly less popular if you took away the PPR relief and made people pay tax on their properties. That would change the discussion quite a lot. Moving on, entrepreneurs got hit in the March budget. The 10 million lifetime limit reduced back down to 1 million. Only 1/5 of CGT payers actually benefit from entrepreneurs relief. But about 2/3 of all gains are on unquoted shares, or taxable gains, because of course residential property isn't taxed. So again, you've got a fairly easy target without losing many votes, which is never a great place to be if you're hoping that tax won't change against you. The final bit, if you like, of the history is inheritance tax, our other capital tax. I don't think you can look at capital gains tax without also looking at inheritance tax. It's tax on death or certain lifetime gifts. We have 100% relief for business property. So shares that would qualify for entrepreneurs relief would typically qualify for 100% relief from inheritance tax. Oddly, we don't have similar relief for residences and other assets. It's a tax based on value, not on gains. And interestingly, you have no capital gains tax on death, but you do get an increase in the base cost of your assets on death. So you can get some slightly odd outcomes depending on when you dispose of shares, business assets. You can take, you can create a capital gains tax liability just before death, get cash in your hand and be taxed on the cash, or you can have, with no increase in value, I suppose you've got that anyway, you've got cash, or you could, if you hold on to your shares at death, then there's no tax on passing those shares on, and the new owners get them at their original, their market value when you die. If you gift them in lifetime, no tax, no inheritance tax, you can roll the gain over and avoid any capital gains tax on the gain, but you don't get the step up in basis. So how you organize yourself, if you're getting on a bit, can impact on your tax. That's not rational for a tax system. IHT, of course, is very unpopular, even though very few people are caught by it. 10% of the number of taxpayers essentially pay IHT as against CGT, but it's hugely unpopular. There's been an all-party parliamentary report on IHT suggesting a flat rate gift tax, getting rid of the CGT uplift on death, but you still have a mixed tax. Why would you have something subject to two taxes on gift? We need to look at creating a coherent tax system around capital assets, which will take rather longer than politicians normally like to wait for a win. So unfortunately, it does feel that at some point in the future, capital gains tax will be reformed, i.e. tax rates are likely to go up, even though there's not necessarily a need to do it. I think that's my history lesson.
Cool.
So
brilliant, and thanks very much for that, Alastair. And just as we go along, if there are any questions anyone wants to ask, either technical ones or non-technical, please just throw them in there. I think we have a Q&A going. I'm sure I'll get a thumbs up from Amy. Yes, I have got a thumbs up from Amy. That's going. So do please put anything in there. And I think the inheritance tax is an important bit to set the part of the context, because I think it hopefully, in reading was keen for Alastair to go through it. Is it contextualise that this CGT thing? It's a whole that there are moving bits to it. I think the other one, and we didn't have a slide on it, and just before we sort of dive into the what could they do and when bit, Alastair, in my mind, and the way we work together is I sort of have the ideas and they say, Matt, you can't do that because Mr. Taxman says no. But if we do tinker with CGT, why would the entrepreneur not start shielding all their gains in a corporate vehicle and pay corporation tax, and then have their cash wrapped up in there and then use it for doing whatever? Because so what I'm asking you, Alastair, is CGT also not linked to corporation tax in some way, shape, or form for an entrepreneur?
Absolutely. There's no question at all that if you play with personal tax rates, whether they be capital gains tax or income tax rates, and leave corporate tax rates as they are, then you create an environment in which people use companies when they otherwise would not, and you do create an environment where some people will build up enough value in their business by iterations of transactions to make going non-resident worthwhile. And of course, there are elements of the capital gains tax regime that completely exempt gains made by companies from taxation. So if you push hard enough on personal tax rates, you create an environment where you get the wrong outcomes from a tax collection and behaviour point of view, and you create an environment where people actually can get themselves to a point where becoming non-resident makes sense, which for individual transactions probably isn't the case. But we've seen that over the years with the low rates, the 10% tax rate on dividends miraculously persuaded everybody to incorporate and use companies to pay dividends, which apparently was not what was intended. We have a long history of a treasury, and this isn't political in that it's as much both main parties are very, very short-sighted in what they're trying to do. And I go back to the point I made earlier. We actually need an overhaul of the whole tax system, not people playing with the bits which make the newspapers for that particular year.
Yeah, so that probably brings us on to the discursive bit, and I think the first question that we sort of raise between us is the what might give and when, and I think putting this session into context, why are we doing it now? Going back, just a month or so ago, the belief was that there would be a November or so budget, and and the tax rates at least they could be changes. The CGT changes could be announced then. They could come in overnight. They could be announced for April. Clearly, that's now been pushed back, and any announcements are due in March. So if Alastair, you and I might be sort of, theorising sort of the what might give and when, sort of looking at March, April next year being sort of short term, and beyond that sort of 2-3 years long bit being this of the medium term. What are your sort of thoughts about the when from what you know? Don't worry, no clients or me going to hold you to any views that you share here, because it's just to discuss, and I don't know what your view is. Spot.
What my view is, well, I think where you start is looking at the leaks that have been coming out of the Treasury and the press briefings over recent years. The content of the budget seems to be set by focus groups. So central government suggests various things might be on the cards, and waits to see what the pushback is. Or actually, Hammond, of course, didn't do that with national insurance, and then reacted to the pushback. So what they're trying to do is avoid that. But we see various things. Talks about changes to the basic rate of income tax, national insurance. Corporation tax increases do seem to be being trailed quite strongly. We have a very low corporate tax rate.
Can I just get on that one again? Because the other bit, and we can't have a conversation about tax without mentioning Brexit and stuff like that. Because in theory, at least the textbook theory was Brexit would allow us to have a freer handle over our taxes, and I think corporation tax was one of those which the government was possibly trying to push down, so we could be ultra competitive in the world. Do you think that view's changed, or has it changed?
There's been a long push, but the corporate tax should have come down in April to 17%, and didn't. And that was pre-COVID. That was an election. That was an election decision to fund the what do they call it? The levelling up. And I think priorities might have changed with this government and with its constituency. So historically, we've chased very low corporate tax rates. Ireland, Malta, a few other places are lower, but there aren't many. And we've done that within the EU. We could probably have gone lower without triggering EU problems. Interestingly, it looks as though those rates are likely to go up. I think the battle will be on other areas of the tax system and state aid as to where we get to. And of course, at the moment, state aid is probably it's one of the two big blockers on a deal with the EU for Brexit. So at the moment, I think literally nobody knows where we're going to end up on state aid. But there are areas that you could see benefit coming through in the future. Patent box and R&D tax credits have been stifled to a degree by the EU rules, so we may see some loosening of those.
Yeah.
Capital allowance rules could improve, all of which would be very good news for business if they're permitted under whatever agreement we reach with the EU. But going back, none of those have been talked about. Those kites haven't flown. There's a list there of kites that have. Pensions tax relief keeps getting a mention. PPR seems to be getting a mention for capital gains tax, but CGT I think does keep raising its head. But I come back to, it doesn't raise much money, so I'm not sure there's much point.
And when it's raising its head, and one of the bits, and listening to Boris and the politicians talking, and Rishi, the word entrepreneur keeps on saying entrepreneur is going to get us out of this. We need entrepreneurs and everything. When they're at the same time when they're talking CGT, are they really thinking entrepreneurs in CGT, or are they thinking, second homeowners and that lot? Are they thinking those who have coming up, as you say, we're saying PE guys, making lots of income, from their carry, but and paying capital gains tax as opposed to income tax and things like that. Any thoughts around that, Alastair?
I think you go back and you look at the history of capital gains tax, which is one of the reasons for the original slide. There has always been something for the business owner, the small private business owner. It was originally retirement relief. You then had business asset taper relief, which was probably overly generous. You then had entrepreneurs relief, which many people view as being untargeted and overly generous, but there has always been something. Now, in March, the government took the lazy way of dealing with the problem of entrepreneurs relief by not focusing it, instead just reducing the lifetime limit. Now, and that follows a pattern. But there has always been a form of entrepreneurs relief. It seems likely that you'd hope that would persist, but it doesn't seem likely that it will be much more generous than the £1 million that we have at the moment.
Although, was there a tiny window when there wasn't between taper relief and entrepreneurs relief? My memory correct or not?
I think you went from business asset taper relief to entrepreneurs relief.
Okay.
So, but you went. Yeah, it's a strange thing that the entrepreneurs relief, the ownership conditions are not terribly onerous, whereas business asset taper relief, originally you need to get to the full rate, you needed 10 years. That's proper capital gain.
Yeah.
Even at the end of taper relief, you had a 4-year holding period, but that requires a real focus on entrepreneurs. And developing value over time, which isn't a particularly easy headline to sell.
Yeah. Do you think the government and HMRC have got the ability, agility, and willingness to focus on the entrepreneur and be brave enough to sort of say, actually, all these entrepreneurs are creating massive value? Because I think it's fully proven that the small businesses contribute, and medium-sized businesses contribute enormously to the economy. Are they brave enough to keep on singling them out and keep on giving them a tax break, if you want to call it that?
I think a break as it stands, I suspect, is likely to continue, but it's at a relatively low level. Do they have the courage to actually carve out something more akin to the kind of 10 million lifetime limit for genuine entrepreneurs? I suspect the answer to that is no. At the moment, I think it plays to the wrong crowd. It doesn't play to the marginal voter who can't distinguish, sorry, that's very rude, but doesn't seem to distinguish between second homeowners, certainly doesn't understand carried interest, and people who create a business and then sell it. There doesn't seem to be that distinction. The effort is not being made to sell that distinction, so it doesn't feel likely that bravery will be there. Will there be some form of ER? There always has been, so one would hope that would continue.
And should there be anything we should read into? I know I made the joke about the bad relief earlier, but the renaming of, because I must admit that slipped me by that they'd rebranded Entrepreneurs Relief, Business Asset Disposal Relief. Maybe they're saving up for a new Entrepreneurs Relief or something. I don't know. Or is it just they're trying to push it out on the sly? And anything to read into that, Alastair?
I suspect it's renamed to try and make it easier to talk about, and to try to avoid having a discussion about whether all those that qualify genuinely are entrepreneurs. I suspect it's about the optics of it rather than anything else. I don't think its longevity will be determined by its name.
Yeah. So moving the conversation on a bit into sort of the the when, and I think another thing that instigated this particular session, we were having a debate about. I'm still going into my gloomy, well, we spent so much money that it all has to be paid for, and it's got to be paid for sooner rather than later. And I think your view, Alastair, was, well, actually, we shouldn't try and tax ourselves into more doom and gloom, and therefore, possibly, although this stuff is hanging there, this might be something that gets kicked along into the long grass for another 12 months or so.
I very much my view is you can't tax your way out of a depression, which is where we seem to be headed. But fortunately, the real economists, seem to agree with me, which is
that's a rare occurrence, isn't it, Alastair?
Very well. They also seem to agree with each other, which is an even rarer occurrence. There does seem to be a pretty widely held view that with interest rates where they are, with QE, there isn't a need to be raising money through taxation at the moment, and the system should be broadly left as it is. And I think that must be good news. generally. Yeah. What it doesn't mean is that you won't get a kind of showboating change to something like CGT, unfortunately. But hopefully it will be on the main rate rather than on the, you know, what I would still call entrepreneurs relief.
Yeah. So I suppose so encapsulating your view there, and you know, and I think we probably all agree it's more of a change to CGT in March to April is going to be more of a political pawn than anything else. And I think probably the gamble for the entrepreneurs is whether or not, you know, that particular political pawn is important, you know, come next spring. Because I think it's, you know, my take on it is this whole thing is all interlinked, and you know, when you tinker with stuff, you know, the side effects of the behaviour, and you use the words behaviour a few times, Alastair, you know, you have this sort of, you know, unknown consequences that can, you know, reduce or remove tax takes or disincentivise entrepreneurs, and then we're even you know, worse position. Cool. Okay. So yeah. You know, many of our clients I know, do sit in, what is clear, you know, is there is massive uncertainty around this, and no matter what Alastair or I say or anyone does, you know, it could all change and it could be horrific in March. It's unlikely, I think. Do you agree, Alastair? It's unlikely to be better than it currently is.
The one thing you and I do agree on about tax changes in March is that they're not likely, taxes aren't likely to go down.
Yeah. Although, you know, rewinding, going back to that, when I asked, you know, back to whenever it was, June 2009, when the CGT rate went up to 28%. I was working on a transaction then where I was buying a business, and the vendors had done all post taper relief, done all sorts of clever planning with a Luxembourg, you know, company, and then I think the new entrepreneurs relief had come in or whatever, and basically they ended up paying a higher rate than they would have done if they'd done nothing. Which probably takes us on to, you know, the final segment, if we want to call them segments, of what we're talking about is, you know, if one is fearful that things could change, you know, in March, what if anything could one do between now and March? Because, you know, going back to it, there is a window, and putting my M&A hat on, and of course I would, you know, advocate, selling a business, and because it is there is enough time and there is enough money out there, and therefore if one is thinking about it, I think it's something that, you know, I would be strongly thinking about again as to whether one would do. But if one, you know, that's not going to be the case for a significant number, you know, of businesses. Is there anything that one can do to try and mitigate some of the risks that might come with a change? And Alastair, we see lots of schemes, etc., talked about and thrown out about there. Have you got a view on those?
I have a pretty strong view on most schemes.
Share with us. Thought you did. That's why I asked the question.
A pretty strong view that you don't go anywhere near them. They're a very expensive way to get tied up in a dispute with the revenue for a very, very long period of time. And you know, current form seems to be that you will lose. You'll lose after spending a great deal on the scheme and a great deal on professional fees to have an argument about it. So you know, the schemes generally, I think, steer well clear of.
Yeah, they tend not to be clear. They tend not to be called schemes. They just tend to be called, you know, good tax planning. And again, I think, you know, that the terminology in the industry has evolved. But
I'm not sure it's evolved that much.
Okay, fair enough.
Bluntly, I mean, there are some strategies that have been mooted in the past for triggering gains or having the potential to trigger gains by forms of rescindable contracts using trusts and so on. I think they come with a very, very heavy duty health warning nowadays. The changes to entrepreneurs relief in March came with some pretty astute anti-avoidance or anti-forestalling provisions, which can well be run out if there's going to be a material change in capital gains tax rates. So the circumstances in which people could play with the date of a disposal or avoid a disposal actually having taken place if the rate didn't change, they were pretty well addressed in the Finance Act earlier this year. I would expect those similar provisions to be in place again if there is a material change in capital gains tax, to make sure that the tax take is what's expected. So you just approach anything that suggests you might be able to have your cake and eat it, have a transaction pre-budget if the rates change, but not have the transaction or not have the tax charge if the rates don't change. I would approach those with a great deal of caution, and just can really suggest, if you're at the point where you're thinking about selling, then think properly about selling, not about trying to just get something over the line in the hope that somebody comes along fairly soon thereafter.
Yeah, and I completely agree with that, and I think the other option, if one wanted to do something, and is if you're thinking about doing a management buyout, but a real management buyout, not a fudged management buyout. If you were going to be doing that, that might be something to think about, doing in the next 6 months or so, and as opposed to deferring it on. But it's the uncertainty that is the killer. The other bit, and you touched on it earlier, Alastair, and we're seeing more of these transactions. But again, for anyone watching, massively encouraging, if you're going to do it, you do it for the right reasons, is employee ownership trust transactions, where effectively you are selling the business to the employees. I suppose it's not effectively, you are selling the business to the employees, and that's owned by a trust. Different to an employee benefit trust. Again, rewinding back to probably my early days in corporate finance, and when Alastair was slightly older than me, there were lots of EBTs out there which people use as quasi warehouses, and did all sorts of income shifting to save a whole load of tax. But employee ownership trusts are something that, if a route of yours was to be selling to employees, is something to think about as a prospective option as well. Again, that is 0% tax at the moment. If things were to change, the 0% could become 10 if all the other CGT rates are 20 or 30. So again, one doesn't know about that. But I think the overall, I think Alastair agreed, the overall Buzzacott view on is there anything you can do, if you are a shareholder owned business, and you've got nothing, there's nothing inadvertently clever from your history or anything like that. I think it's stick it out if you're not going to sell, and see what's on the other side, because part of the Buzzacott business does sadly make some money from those who've been hoodwinked into trying to save tax, and we then later on try and bail them out. So as Alastair said, check very carefully if someone is trying to talk to you about minimising charge. I think just a couple of other things on for the entrepreneur, and I think because of the uncertainty, it's not all, it shouldn't be all bad. I think, and Alastair, you touched on a few things that might change. Things like EIS and EMI are great tax reliefs. R&D. The government are trying and will continue to try and make running that entrepreneurial business ultimately, to be honest, as profitable as it could be. Is there anything else in the pipeline, Alastair, that you've heard wind of that might make the entrepreneur's life easier?
I don't think there is a great deal. You know, as we said, I said earlier, R&D and patent box, which can be of huge benefit, have been constrained by EU rules. The Germans, I think, particularly didn't like our patent box regime. And if we do, or when we finally leave the EU completely, there may well be a great deal more flexibility. And you may see, you may well see more in terms of the encouragement of investment in plant and machinery technology. I mean, I'm old enough to remember, you're not, Matt, but when there used to be a specific capital allowance for computer equipment, for IT equipment. You know,
I did that in exams, Alastair. I'm sure I remember that one. That was those multiple choice cards I had to remember.
Well, there you are. You see,
I can't remember the rate though.
No, it's a bit like ACT. It's long in the distant past. But you know, you may see targeted reliefs or expanded reliefs. You may see changes to R&D, expansions of it. It's very difficult to tell what will happen. But we have had a history over the last 20 years or so of rhetoric, and rhetoric backed up by relief and effort to enhance the entrepreneurial businesses, to enhance a research and development spend in the UK. So you've got to hope that one of the pluses from leaving the European Union is going to be increased freedom and increased flexibility to help those sectors.
Cool. So I've got there's a question for you, Alastair, about I think it's about extracting surplus cash in a sale. Is there likely to be any changes to legislation around that cash that might be surplus in a business that currently entrepreneurs can get out at a capital gains tax rate? Could that ever be looked at and become a dividend tax rate?
I don't know whether that's a plant or a real question from somebody, but I'm grateful to whoever it is, because it's something that we meant to touch on. I don't think you need a change in law. The law is already there to tax as income, to tax as dividends, surplus cash, certainly surplus profits, but surplus cash within businesses on a sale. So I don't think there's a risk of a change in law because the law is already there, but I think that there must be a risk that what's called the transactions and securities rules will be looked at much more closely by the revenue when they are giving the clearance that we always seek on a transaction. So yeah, it's been funny over the last 4 or 5 years. I think the rules have been applied probably more loosely than one would have expected in some situations. So and the revenue don't have a great deal of bandwidth at the moment. They're quite busy with Brexit and everything else that's going on. But over time, I think you'd have to expect them to look at the anti-avoidance rules more closely.
Cool, brilliant. I've got another question, Alastair. If I sell my business and I have an earn-out that is paid in 2022, what tax rate am I likely to pay?
Depends how it's structured. You would typically try to trigger, and certainly at the moment, I think you'd try and put yourself in a position where the earn-out was taxed today, at the date of, you know, let's say pre-budget transaction. In any, an earn-out's going to be taxed if you assume it's structured appropriately, yeah, so that it's taxed as capital gains rather than as income. You are going to have tax at the date of your transaction. It's just then, do you get further tax in the future when you receive the earn-out? And that's done by treating the earn-out as an asset in its own right, which you then sell over time. So you would try to get yourself in a position where your earn-out is deemed to be measurable, quantifiable, and taxed in full at the date of your original transaction. So hopefully you'd pay 10 or 20%.
Yeah. Cool. And also with the, I suppose, with the earn out and one is allowed to change your tax return. As so if we did if a transaction completed today, for example, that's your April. When I say allowed, that's my language, not necessarily what HMRC say. That'd be your April 5th tax return that you prepare in January 2022. I think if I got my dates right. And then you completely close it in January 23. Is that? Do you want to put the professional answer in, Alastair?
That's close enough. But you're quite right. You're not allowed to change your tax return. I didn't like that outcome, but you are allowed to amend it to make it correct.
No, amend it. That's the word. Sorry.
But it's to make it correct rather than change the outcome. But yes, you would look at the circumstances over time. But I think what you want to do is have you want to be in a position to file with certainty that your earnout is taxable at the date of in full at the date of transaction, if at all possible. The next best thing is to play with the valuation of that earnout over time if you need to, but that is not the preferable route.
Yeah, cool. Brilliant. Well, I think as we head towards 1 p.m, and I'm sure that the for the majority of you who are at home, the food is in the oven and will be popping out shortly to for lunch. I think to wrap up, and I touched on the M&A market at the beginning, and it genuinely is right now, and a good market, and there is the private equity houses and the listed companies have got lots of money, and they are all out actively looking for businesses to buy. So there is that. I think what Alastair and I haven't reached, and I would hope that none of you were expecting us to reach a conclusion as to what the Chancellor would stand up and say in March. But what we do know is that there is uncertainty. I think probably you can take from this, and Alice will I'm sure nod or speak up, that our current view today, this hour, this minute, is that we think a change, although possible, is not probable. Is that fair enough, Alastair? Was that?
I think significant change. I think I think you can. It wouldn't be ridiculous to expect a small increase in main rate, but whether I think it's unlikely it'll go up to the income tax rates would be my feel, but who knows?
Yeah. But I think that the bit that is it's the uncertainty, and I think that's the main thing. It's the uncertainty that's a killer for everybody, and the entrepreneurs relief change back in back in March this year. I know for those that transactions we were working on, and sadly there was one that at least we weren't able to get over the line beforehand for things that were outside of our controls. Just genuine why using the spectre word in the title of this, the uncertainty is it can be a great transaction driver to focus people towards, but also the uncertainty is something that really causes stress and anxiety in transactions, and ideally you don't really want to find yourself, if you're going to do something, up against that wall of concern, even if nothing changes overnight. But it's what we are certain about is that uncertainty's going to be there in March next year, and possibly post that we will reprise this conversation and talk about when the next change might come, because sadly it might be that we're still in a COVID zone, and the government will defer making any major changes or any changes for a significant period of time, because they might still be in spend mode as opposed to tax mode. So I think that's all I wanted to say. Alastair, any closing remarks, any bits of genius other than the prior 55 minutes of genius?
No genius whatsoever. I mean, the one thing that is certain, I think, is that we will have a budget in the spring. There has to be one. so that they can continue to raise income tax. But what it will contain, yeah, who knows?
Well, brilliant. Thank you ever so much, Alastair, for your contribution. It's greatly appreciated. Thank you all very much for watching. I hope you have great afternoons, and probably the next webinar, well, definitely the next webinar I'll be doing. I'll be back at home with my bookshelf behind me. Anyway, see you all soon. Thank you.